As I intro, if my first group would want to start coming up, I'll give a little bit of a background here. We're going to have Mr. Andrew Schreiner from Fidelity moderate a panel of three. Jack Vanderhei, Director of Research from eBree, Bob Holcomb, who runs Legislative and Regulatory Affairs for Empower Retirement, and Amy Dyson, who's the VP of Retail Retirement Plans with Ameriprise Financial. What we're going to do is kind of a two-parter here. We're going to start with Jack. Jack was asked to look at the major policy proposals that are on the docket today and look at his retirement security model, projection model, and look and see what the potential implications are of all those major components, whether it's the changing of the MRD ages, whether it's talking about open MEPs. We've got a fairly deep view, as we would expect from Jack, on several items there. And then after Jack sets the stage with that data, then we'll go through a discussion from some of the practitioners about what they're seeing, kind of a thought leadership view of what's going on in the public policy arena out in the world that we live in today. So, Andy, I'll hand it over to you.
Can everybody hear me? How's everyone doing this morning? Good? I'm from Boston, and any place that is over 50 degrees is a good place to be, so happy to be here. I'm just going to give a quick introduction and ask Bob and Amy and Jack to give a little personal background, and then Jack will walk through the retirement security projection model and the different, some of the different legislative provisions that we're facing right now in RISA and the Secure Act. So a little bit of background on myself. Right now, my current title is SVP of DC Innovation. That's Defined Contribution Innovation, not Washington, D.C., although that would be interesting too. That's a recent change for me. I spent the past decade plus leading Fidelity's public policy efforts. So now I'm leading a team of folks who are looking into things like MEPS, emergency savings and the like, and thinking about that from a product side. So that's the background that I bring to this. When I was thinking about it yesterday, when I joined Fidelity, it was August of 2006. Mike was there with me. It was right after the Pension Protection Act passed. And one of the first things I worked on was a brochure to our clients outlining for them all the different great aspects of the Pension Protection Act. And it's fascinating just how fast time goes, but also how slow it takes to get legislation moving and passed. And I hope we're finally reaching the time which we're going to get another monumental bill passed at some point this year. So I'm excited for that and excited to talk to you all today about some of the provisions. So I'm going to kick it over to Bob, Amy, and Jack just to give a quick bio, and then Jack, you can walk through some of your interesting research.
Well, thank you, Andrew. My name is Bob Holcomb, and I head up the Legislative Regulatory Affairs Department for Empower Retirement. I've been in the industry, you mentioned coming in around PPA. You can always tell a true ERISA nerd because they pegged the time that they first started working in the industry with whatever was a major piece of tax legislation that might have happened. I came in just in time for the provisions of TRA 86 to start becoming effective. So I've been here, been in the industry for a little bit. But, as with Andrew or Andy, we are very excited about some of the things that we're seeing in Congress right now and, hopefully get some major pension reform soon.
And thank you, Andy. My name is Amy Dyson. I work at Ameriprise Financial as the Vice President of Retail Retirement Plans. And what I do is I head up the product development group there for all retirement plans, whether it's the 401k, 403b, or IRA side of the business. I have been focused on retirement planning for the last 25 years, but in a lot of different capacities. I've worked with sales, I've worked in the marketing department, our mutual fund department, and most recently our product development department. And I have a lot of passion around this topic. I think this is a really exciting time for us. People need to save for retirement. They need to save more. It's part of our role in the industry in helping them. And I think this is just a great time to really start helping individuals do a better job for themselves and really understand what's available to them. Jack.
Thank you. I'm Jack Vanderheim, the research director at eBury. I've been here 31 years now this month, and I can't tell you how excited I am to finally be in a situation where we not only have the kind of databases we put together with ICI, for example, on the 401k side, but have all the different elements we need, largely through cooperation of our members, to put together models that are going to hopefully be instructive in terms of legislative proposals. So I'm very much looking forward to today's conversation.
Thanks, Jack. And so, Jack, you can take us through some of the recent research that you and team have done.
Okay. So what I'm going to try to do very quickly in 15 minutes is go through a number of the most important proposals. As Michael mentioned, with PPAC, we meet on a regular basis, try to figure out what are the most important elements of different legislative proposals that are out there, and take a look at what the likely impact is. I should mention up front, this is not necessarily a complete analysis of any of the legislative proposals Andy mentioned. It's not a complete analysis of Automatic Retirement Plan Act. We still have some additional elements we're working on, for example, enhanced savers credit, but we're certainly expecting that later this month we will have an issue brief out that will hopefully put all this together for you. Very quickly, as far as the outline, I want to go through very quickly a background on the model that we're going to be using, the retirement security projection model. The reason I think it's important to spend at least a couple minutes, this is very much unlike many of the other models you see around town. This is not a replacement ratio model, for example. We actually look at the full decumulation phase and figure out basically what's the probability of having a successful retirement. I'll define that for you in a couple seconds. After I do that, I'm going to just give you some quick baselines to look at what average retirement deficits are by age, with and without Social Security reductions. Very quickly, we'll look at some of the average retirement deficits by age and future eligibility for DC plans. And the reason I'm going to spend some time on that slide, because I think it's going to be very clear after looking at that slide why so much of the conversation in terms of retirement income adequacy revolves around increasing coverage, increasing access. So hopefully that'll be clear. Then as far as the components I'm going to model for today's presentation, I'm going to have one slide, hard to believe, on plan coverage and enhancements. It's going to look at mandatory coverage for all employers except the very smallest. And the assumption is going to be those that basically end up with new plans that don't have them currently are all coming in as auto IRAs. We're doing sensitivity analysis around that, but just for the baseline today, that's what I'm going to start with. I'm going to also show very quickly what's the impact of increasing the auto escalation limit from 10 to 15%. Under ARPA, for example, it starts at 6, escalates to 10. We're going to show the impact of going up to 15. Going to show the impact of including part-time employees as far as the overall retirement income adequacy. And then I'm sure we've all heard this over and over and over. One of the biggest problems with today's system still is that of leakage, and try to show as a plan enhancement what would happen if we had full auto portability. Now, this is not necessarily tied to any particular product that's out there. This is just basically saying if every time somebody leaves a job before they retire, if those account balances could basically be held in some kind of clearinghouse until they end up with another employer and then rolled over. Basically, if you can eliminate leakages, how much of a difference is that going to make? Then we're going to go very quickly on a slide on what would happen if we had the guaranteed income for life element that's been talked about in several of the proposals. As was mentioned, I'm going to spend a little time on open MEPs. And then very quickly, we'll have something on required minimum distributions. Because of the way our model is defined, I'm not going to be able to show you how that's going to impact on retirement income adequacy. I think hopefully that'll be clear in a couple seconds, but at least show you if something like this was enacted, at least in the short term, how much difference it would have in terms of the distributions. And then end this with some key takeaways. There's a lot of material in the appendix I'm not going to have time to go through. If you want more detail on how the model works, etc., some of the other breakouts, that should be in there for you. The model. This is something Craig Copeland and I did back in the late 90s. In essence, Millbank Memorial Fund came to us and said many of the governors were very paranoid that they had no idea what they were looking at in terms of future generations of retirees and when they would become financially indigent. And if they became financially indigent, the governors would be on the hook for things like Medicaid, for their nursing home costs, et cetera. So we did one for Oregon, we did one for Kansas, we did one for Massachusetts, and before my previous boss asked me to do the other 47 states, we just went ahead and combined it all into one big national retirement income model. 2 phases. In the accumulation phase, we basically look at everybody from 35 to 64. We can go younger if you absolutely need to, but there is much more standard error for the young individuals. We look at DC, DB, IRA, Social Security, and net housing equity. Basically, we're very, very lucky because of the work we do with ICI. We have the world's largest 401k database, so I can get all the behavioral assumptions I need, for example. We've got over 27 million employees and 110,000 plans. These linked records go all the way back to '96. We also have an IRA database that Craig administers with 25 million accounts, 20 million unique individuals. So basically, we get everybody out to retirement age. We're going to baseline at 65 for today, but we can certainly change that. Then, unlike many of the other models, we have a retirement phase. We just don't get you to 65, say, here's your replacement rate, is it bigger or less than a particular ad hoc threshold. We take 1,000 simulated life paths for each household starting at 65, and we do 2 kinds of costs. The ones that are easy to figure out, the deterministic costs, food, apparel, transportation, etc. We can get a pretty good handle on that just from government data. But the one that I think is the most important for overall financial planning and retirement, you want to look at longevity risk. You want to look at long-term care risk. You want to look at post-retirement investment risk. So basically, we have this massive simulation model that takes all that into account. What do we end up with? Well, for each of the 1,000 life paths for each household, sometimes you run short of money and sometimes you don't. If you want the technical definition, it's in the appendix. We do 2 different types of measures here. It's on the very bottom in red. The first one is just a probability of success, a retirement readiness rating. It's a probability of not running short of money in retirement. If you don't run short of money in retirement, that's a successful retirement as far as we're concerned. But it makes a big difference between whether you run short by just a couple bucks or whether you run short by hundreds of thousands of dollars. So the one we're going to focus on today, retirement savings shortfall, I take the present value of deficits for those who run short of money in retirement. How big is that? Last bullet point on this page, if you take the aggregate deficit for all households currently ages 35 to 64, in today's dollars, they'll need an extra $3.8 trillion. So that's our baseline. That's what we're coming at from a starting point in terms of how big the retirement deficit is. And what I'm going to be focusing on in the next couple of slides is to look at how much these different legislative proposals could change that. Very quickly, let's break out that $3.8 trillion into age categories. I have this into 5-year cohorts. It's pretty constant on the baseline, on the blue lines across the ages, but you will see, oh, by the way, baseline, we assume statutory Social Security benefits continue to be paid out as scheduled. If indeed you look at the fact that the trust fund is scheduled to run out in 15 years, if you take a 24% cut of all benefits at that particular time, it makes a relatively big difference for the younger people, not so much for the older individuals. So if you look at that red rectangle of Social Security benefits are paid out as expected, it's just short of $50,000 per person as far as an average deficit, goes up to $57,586 if indeed there is a 24% cut in Social Security benefits. What about future eligibility for defined contribution plans? There's nothing we can do in terms of what's already happened in terms of your defined contribution participation, but in terms of eligibility in the future, what we do is we break out each of these individuals into various years of eligibility, whether or not they take advantage of it. Just this is strictly coverage. And if you look at, again, the red rectangle for the youngest cohort, you see for those people who are unlucky enough never to work for a sponsor of a DC plan from now until the time they retire, on average, they have a deficit of $78,000. If you drop all the way to the bottom of that red rectangle, for those people who are fortunate to basically work all their future years for somebody who sponsors a plan, then I can drop that by about a factor of 5.5 times down to only 14 grand. So that really shows why coverage, why expanding access to retirement plans is so important in terms of looking at future overall retirement income adequacy. Now, as far as the plan or the coverage enhancements, I jammed 4 of them into one, so hopefully this will make sense as I explain it. But for each of these age cohorts, I have 4 different scenarios. Scenario A, I'm going to assume the plans required for all employers except the smallest, basically 10 and under, are being excluded from this. I realize that if we're not going to use the M word, but if you end up doing a plan that you haven't had to do in the past, you might do something like a 401k or a 403b. For the sake of argument, just to get started, I'm assuming any new sponsors come in as an auto IRA. I assume it's a 6% default. I assume it's an escalation 10%. I'm also assuming for the new plans, there's a 30% opt-out for new eligibles, which is fairly close to what we're seeing right now for Oregon Saves. That might change as some of the waves of smaller employers come in, but at least for the baseline, that's what I'm assuming. So if you look, again, all the way on the left-hand side for that youngest cohort, 35 to 39, scenario A is the blue bar. It's about a 15% reduction in deficits for that age cohort if that happens. Okay, scenario B, the yellow bar, is the same thing as A, but instead of escalating to 10, we let it escalate to 15, and basically we get about another 2% reduction in deficits for the youngest cohort. Again, I'm focusing on the youngest cohort because obviously the older you are when this takes effect, the fewer years you have to benefit from this. Option C might come as a little bit of a surprise to you, including part-time employees. Only, again, reduces the deficit by about another 1%, but again, so much of that impact has already been picked up in scenario A that the marginal impact of bringing in part-time employees is relatively small. And then also, as I said, I wanted to look at a full auto portability, and you can see in option D, the green bar for the youngest individuals, that will increase, if we can get rid of leakages, that will increase the deficit reduction by about another 10 percentage points. So crammed into all one chart, the 4 different scenarios, and for each age. Now, very quickly, guaranteed income for life. I have absolutely no idea. You're going to put together an option where people can get up to 50% of their K balances at age 65. How many people are going to take advantage of it? I have absolutely no idea. So instead of trying to do an overall retirement income adequacy number, what I did is do a stylistic scenario in which I'm looking at individuals and seeing how much their retirement deficits will decrease. Probably not a big surprise for those people who put 50% of their K balance into a SPIA at 65. If you die relatively early, that is going to be a negative reduction in deficits because you've taken part of the money you could have lived on otherwise, and in essence, you haven't had enough payments from the SPIA to offset that. But by the time you get to age 85 and above, you see positive reductions in the deficit, which by the time you get out to the 95 to 100 on average is about a $3,000 reduction. The most important part of that slide, though, go all the way to the right-hand side, and if you take the average across all simulated ages of death, we end up with a positive of almost a $1,000 reduction, $985 on average for individuals who do take advantage of the option that's being discussed, where you take 50% of your K balance and put it into a SPIA. Open MEPS. Again, there's been some very good surveys out. You can end up with probabilities anywhere from 1/3 to 2/3, depending on whose survey you look at, as far as small employers who don't have plans who are likely to take advantage of open MEPS. But again, instead of trying to look at what the overall impacts are going to be on the universe, what I did was to focus instead on individuals who take advantage of the open MEPS. I'm not sure how many that's going to be, but let's just take a look for an individual what that's likely to translate to. This one's a little bit more difficult to understand because what I do is I break it down into quartiles of the distribution of years in the workforce without eligibility for an employer-sponsored retirement plan. So if you're already working every single year in the future for somebody who has an employer-sponsored plan, an open MEP's not going to be doing anything for you because you're already covered, eligible, etc. So basically we split it out to people on the left side, they benefit from an open MEP for a couple of years. People on the right side, they benefit from an open MEP so much that they're in the top 25%. And the bottom line is, if you look at people currently 35 to 39, my youngest age cohort, there is more than a quarter, a 26% reduction in overall deficits from having the open MEPS. So basically you're taking a situation where under the baseline, you did not have coverage in those years. We're now transferring you into an open MEP. You're benefiting from it for those years, and we're able to reduce the deficit by more than 25%. And to finally finish this up quickly, RMDs, again, the way we do the model, whether or not you're forced to take an RMD is not going to make any difference with respect to your probability of a successful retirement. But since so many people were interested in what this was going to do in terms of distributions, I ran from Craig's most recent 2016 IRA database what would happen for those people ages 71 to 100 from increasing either the life expectancy or the start age, or both, as far as what would happen on RMDs. So at the very top row, I'm assuming there's a 5% increase in life expectancy, which is going to, by definition, change how much you're taking out each year. And I'm assuming you're going to increase the start age by 2 years, so from 70.5 to 72.5. In that case, for the total amount of everybody 71 to 100, we have about a 5.5% decrease in IRA distributions for that first year. If you look only at the non-Roth IRAs, we get you up to about 6.5%. Now, obviously, this is a one-time shock to the system. It's going to come back into equilibrium within a couple of years. But as far as worried about what's going to happen during those short-term transition years, I think that gives you a pretty good feel. Again, if you think 5% is not big enough in the life expectancy, I also have 10% on the bottom. And if you think 2 years is too much for the start date, I also have a 1 year in there for you, if you'd like to take a look at that. So before I get the hook, my key takeaways, my aggregate retirement deficits, as we said, everybody 35 to 64, whether or not they currently have a retirement plan, so there's a lot of households that don't, we're talking about a $3.8 trillion deficit in 2019. Unlike other people who have oftentimes said there's going to be a big generational effect, this is relatively constant across age cohorts. Unless Social Security benefits are reduced, then you're going to have a much bigger deficit for the young people. Future years of eligibility for DC plans can decrease the averages by as much as 5.5 times for the youngest cohort, which should be the big takeaway here as far as the need for increasing coverage. As far as plan enhancements, looking at the youngest cohort, expand coverage to all but the smallest employers, I can get the average deficit down by 15. Increasing escalation from 10 to 15 or expanding to part-timers gets me an additional 1 to 2% at the margin. But again, the big impact here is adding full auto portability will reduce the deficits by an additional 10% over and above what we already saw. Guaranteed income for life, I'm excluding the balances less than $5,000. I get an overall decrease in retirement deficits of nearly $1,000 per individual for those who utilize it. Open MEPS, if I look at the youngest cohort who would have had the top quartile in years of not being covered, I can get a 27% decrease in overall retirement deficits. And again, on the RMD modifications, it's a one-time shock, not a big deal as far as retirement income adequacy, but a 10% increase in life expectancy and deferring the start age by 2 years would have decreased the 2016 IRA distributions, had it taken effect in 2016, for those over 70 by about 8.4%. So I thank you very much, and we'll move on to the discussion. I look forward to the questions and answers later on. Thank you.
Jack, thank you. Thank you for getting through so much information so quickly. That was very impressive. I'm going to start. We have a whole host of issues within RISA and the Secure Act that I want to try to get the take of the panel on, and obviously welcome thoughts from the audience as well. So be thinking about questions you might have. I'm going to start with MEPS, something near and dear to my own heart as I'm working on that product as we speak. Clearly, Jack, the data that you showed shows that it can have a significant impact on especially younger workers who are uncovered. And I think one of the things that at least, I think about in my perch is that, open MEPs are not going to be a panacea for the entire uncovered, right? It's a solution for a part of the market. And that market and the uncovered market is going to evolve over time, and we're seeing that with state-run plans and other proposals. Some people though have raised questions as to whether or not open MEPs would cannibalize other existing savings vehicles, and so both from Bob from a legislative perspective, I'm curious to get your take on the provisions that are in the bill and whether or not there's anything else that's out there that would could help enhance that. And then Amy, your take just generally, pros and cons about MEPs, what the possibilities are. Is this a big nothing, or is this something that could really monumentally change the way that the industry offers retirement savings plans? I know that's a lot, so take whatever you want.
Well, I'll go ahead and start off. When Jack alluded to or made reference to surveys that were out there regarding interest and potential take-up in MEPs, one of those surveys, I think you were mentioning, was one that was sponsored by Empower. And we saw significant interest in the small employer market among plan sponsors that did not currently sponsor 401k plan, or sorry, employers who did not currently sponsor 401k plans were very interested in the MEP provisions. And as we've seen from data over the years, some of the biggest concerns that these small employers have are the complexity of the administration, the cost of running a plan, and concerns around fiduciary responsibility and liability that they may be incurring. So I think that the open MEP provisions in both RISA and Secure go a long ways to addressing those issues. We have been supporters of both the MEP provisions. They've been around for years. This is not a new concept. We're very, very pleased to see that that Congress is inching closer towards perhaps actually passing these provisions, and hopefully current affairs will not distract them from moving forward. But we're very hopeful to see something in place. Now, as far as how the market develops, I think there are a couple of big question marks there. I think probably one of the biggest question marks is the provision under MEPs that the preferred plan provider in the MEP has to take on fiduciary responsibility, has to be named a fiduciary under the open MEP. So we'll be watching very carefully to see how the market develops, given that we're primarily talking about the smaller end of business, smaller employers. That market has traditionally been sold and serviced by the advisor and consultant community. And many of these individuals are already taking on fiduciary responsibilities around investments under 338. The question is, will they want to expand that fiduciary responsibility and take on the administration? So, and then also the question is, how will the financial services industries react? Will they be willing to become a fiduciary under MEP? So I think those are some of the open questions, and if we can get RISA and Secure across the finish line, then I think a lot of firms, many of whom are represented here, will start developing their business models as how they want to address this opportunity.
Okay, well, when I think about MEPS and when I think about open MEPS, I think that there's really kind of two different roads that we can go down. We can go down the road of uncovered employees, and then we can go down the road of employers that already have a plan, but they're small employers and they're looking for higher quality services potentially. They're looking to lower their prices. So it really, there's two different groups I think about when I think about MEPS. And my first thought is always, we need to be really patient in order to see what's going to happen. Whenever we've seen new legislation, whether it's been HSAs, Roths inside of 401ks, it has taken a significant amount of time to get uptake. In particular, because these are small business owners, it will probably take even longer because they're going to have to really go out and do due diligence almost again. It's like re-benchmarking your 401k plan. And so I think that there is truly an opportunity, particularly if we have enough people understanding how an open MEP could help support their small business. I also think that having high quality digital advice is going to be really, really helpful. Folks are looking for an ability to get advice and move the dial. But if you're an open MEP, that means geographically, you're in a lot of different areas. And what I like to think about is how does an advisor support that plan, or how does a 401k plan support that? And really what you're going to want to do is you're going to want to have some sort of great online presence that will help the individual. So I think there's lots of possibilities, but in particular, I think we have to really take our time and understand this is going to be a slow-moving vehicle, probably, and we're going to really have to educate people as to how it works. But more services, that's a good thing, certainly for the small and micro small business owner. Figuring out a way to price it appropriately is going to make a difference. So I think that's where we're going to have to start. Certainly time is going to tell us more.
That's great, thank you. And likewise, we've been looking at it in a similar way. I think it's just a matter of we at Fidelity just trying to figure out, where are those markets, right? I mean, traditionally, you're talking about small businesses that have not offered a plan to date. And, Bob, you mentioned some of the reasons why they haven't. I was curious, both of your takes on how this might be distributed to small businesses and sold to small businesses. And really, is this just another one of the alphabet soup of retirement plans that are out there, or how can it be potentially a game changer for a cohort of businesses that to date have not necessarily found enough value in providing a retirement savings plan to make that leap?
So when you ask how would it be distributed, I'm a huge believer in, obviously, face-to-face financial planning. Our expectation is advisors would really have to be engaged and involved in this process. You're going to need an expert to help you understand who is going to fit into your open MEP, how it's going to benefit you best, and that's the education. And that advisor is also going to be able to help you sort of kick the tires around. And that advisor would also be able to help you kick the tires around, how does this plan make sense for me? So I see a lot of engagement with a plan sponsor, with a broker-dealer in order to understand, does this make sense? People need help with their 401ks, and I think that takes an individual. That's how we see it being distributed.
Okay, thanks.
And I would agree. I mentioned earlier that this marketplace, particularly the smaller employers, has typically been serviced and by the advisor consultant community, and I don't see that changing. I see that those are the entities who have developed the relationships. To your earlier question or earlier comment, is this just one of another set of alphabet soups? I think MEPs are different in one way. We're not trying to create a simplified, different type of savings vehicle. We're trying to develop a way to efficiently and cost-effectively give small employers access to the same type of plans that larger mid-sized employers have. So that's why I feel hopeful that MEPS might go down a different route than, say, the Simples, the SEPs, and some of the other efforts to close the coverage gap.
Yep, and to kind of close that out, I mean, I agree with both of what you said. I think, from an industry perspective, it's going to be impinged upon us to build something that it actually, delivers the value to the small businesses. And I think, while the advisor community clearly is, historically been the way in which small businesses have received these, I think that we need to be thinking broader than that as well, thinking about other distribution channels, whether trade associations that have, typically helped service some of the small businesses through, on a regional level, even thinking about state-run plans and I know we're not supposed to use the M word, but I think as you think about the future, the mandates that could potentially come down on employers to offer retirement savings, I think that you could end up seeing a melding of MEPs and mandates. So I hope that's not a quote that's going to be put somewhere. One final question I have for you on MEPs, and then we'll pivot to some of the other provisions. There has been a lot of talk over the past couple of years, up and down, about gig workers and the contingent workforce of the future, and different studies that show just how it's going to overtake the economy, and the need to develop, quote unquote, portable benefits for these folks. Clearly, MEPs could potentially fit into that. I'm just curious your take on the need for benefits for this cohort in the future, and just different thoughts on public policy proposals that might be out there.
Well, definitely there is a need. I mean, we see increasing numbers of individuals who are participating in the gig economy, making sure that they have access to a good, effective workplace type of savings arrangement, I think, is very important. That being said, I don't know that the MEP provisions as currently written would necessarily address it. I think there are a number of questions that need to be answered still, and those answers could come from additional legislation or clarification by the Department of Labor and other regulatory agencies. So I think that's still very much an open question.
I'm going to agree with Bob. I think that benefits in general are going to continue to be a bigger and bigger conversation through the next, several decades and beyond. I think we have more to think about when it comes to portability, whether or not it's going to work for MEPS. I guess I'm not sure if it's going to be something that MEPS is going to help or not.
That's fair. We can pivot, and maybe, Jack, I'll turn to you initially. One of the other big provisions is a change to the contribution escalation cap in the legislation, which would remove that in certain ways. I'm curious your research on that, your take on that, whether or not that would provide enough incentive to plan sponsors to move their participants up to higher savings levels over time.
Lori and I did a study back in 2010, I believe, and took a look at how much difference that would make in terms of overall success rates. And so, as opposed to what I did today, where it got kind of combined in with everything else, I think there was and again, when you break it out by income quartile, it makes a huge difference, but I think there was enough positive impact on the taking off the 10% cap and allowing it to go up to 15 that it would catch the plan sponsor's attention, and I think that would definitely be something that a significant portion of them would end up wanting to make that change.
That's great. Thank you.
So I hate to disagree with Jack, but I'm a big believer in just because you can doesn't necessarily mean you should. So in increasing an auto escalation, say from 10 to 15%, I think that takes on a lot of responsibility as a plan administrator or as a plan sponsor. We have got a lot of individuals out there that would absolutely allow that plan contribution to go up and up and up. But when that happens, there is some sort of impact somewhere else in their financial security. And I wonder if the employer is going to feel really confident about understanding whether or not that individual has a lot of debt. That individual might have something else they should be saving for. So I think, 10% is a great number. And I'm not against the legislation. I think let's go ahead and do it. But I think that plan sponsor needs to really think about what that is going to do holistically to that individual participant if you continue to ratchet it up to 15%. So I think in certain situations, and particularly for individuals that can afford it, it might make sense. And you do have the opt-out, of course. But in other scenarios, I think that there might be a risk, and that's taking on a lot of responsibility for the plan sponsor.
Well, I would probably tend to agree with Jack and some of his conclusions. And in fact, if you look at the RISA version, they would eliminate the cap altogether. And so just raising it to 15%. I think there are some definite positives allowing those rates to ratchet up. And I do understand the argument that individuals may have other commitments, debt that might prove problematic. But as you mentioned, we do have that opt-out provision. I would actually take it one step further. And when you look at the automatic suite, automatic enrollment at whatever your default level is, automatic increase. We've all seen what a powerful tool inertia can be, yes. And how this has probably helped move the needle as far as retirement savings more than any other provisions we've seen over the years. I would take it one step further, and I would look at provisions that we see in both the Automatic Retirement Plan Act, where there would be a form of a mandate, and then also in the bill that Senators Portman and Cardin are going to be introducing, where they're doing it more as an encouragement, and that's automatic re-enrollment. I think that automatic re-enrollment is as important a part of the automatic suite as automatic enrollment and as automatic acceleration, because it goes back and it captures those individuals who may have opted out initially based upon their situation, and then provides an opportunity to get them back into the plan. My comment's always been, once a year I'm required to look at my health savings, my health plan, and make decisions regarding what I want. I don't think it's unreasonable to place that same sort of a decision to individuals as they're looking at retirement.
Just 2 quick points. On the automatic re-enrollment, that is something we're going to be modeling. Just didn't have it ready for today. And by the way, if you have any suggestions on other things you'd like to see modeled as part of this forthcoming issue brief, just feel free to send me an email at vanderheide.org. With respect to Amy's comment, I certainly agree from the standpoint of feasibility in terms of administration, but the 10% oftentimes is going to sound like it's going to be sufficient when you're bringing employees in at a very young age. When you've got the mid-career hires who unfortunately may not have had any coverage previously or may have cashed out those amounts, I think having the ability to get those people escalated up to 15% is going to be extremely important.
Thanks, Jack. Bob, your last point about the kind of annual financial checkup of sorts, I think it's a great idea myself, and I couldn't agree more on that. One thing, Jack, and I guess, Amy, this gets to your question about other needs. If there's any way to take a deeper look at certain income cohorts, especially lower income earners, in the need for emergency savings, right? And so that continues to come up and up with our plan sponsor clients in the discussions we've been having. The increased loan usage on 401ks, especially for those who are auto-enrolled at higher levels, and how that might be balanced in the future, I think is another interesting topic to look So now I'm going to move from the M word to the A word, annuities. Lifetime income in some of these bills, especially there's an annuity safe harbor for in-plans, and I'm just curious to get your take on that and kind of where things are just, from a demand perspective. Amy, you might have some comments there. I think, long both policymakers, industry, others are trying to figure out how do we land the plane on lifetime income, and what are the policy solutions that we should be putting forth to help people make sure that they're taking their balance and, achieving the lifetime income that they need, recognizing that, everybody has Social Security and the like. So just curious your take on that, whether or not there's, high demand in plans for, in-plan annuity options, lifetime income options, and then, Bob, your take on the legislation as well.
Well, when I think about lifetime income options, the first thing I think is inside of your 401k, I consider that an accumulation vehicle. That's where people feel really good about the fact that I need to save more, I need to save often, and I need a great asset allocation process, and that's where I'm going to build this wealth bucket. And it's a new sort of series of thoughts to start thinking, but I also need to create income from that 401k plan. People don't usually think about it that way. When we've seen demand, when it comes to some sort of annuity feature inside of a 401k plan, usually it's the plan sponsor. They want to help. They're concerned about retirement income. They certainly understand longevity issues. They also want people to feel confident retiring, and with some form of income that they feel confident about, they're able to retire, and we can get new people into the workforce. The problem is it's the sponsor that's more interested than the actual participant. So when we see that feature, the participant is still in the mindset of, I want to save, I want to grow, and they're not thinking as much about either the income, or they're not confident enough to say, hey, I'd like to understand this product and really research it and try it on for size. I think that there are some new tools, certainly to take a look at, that could help demonstrate and illustrate how an income feature would work inside of a 401k plan. But right now, we're not seeing that huge demand. It's the idea is, I think, a great idea. Portability is a nice thing to have, but the participant is usually thinking about retirement income. Once they do retire, once they take that money, they move it to an IRA, and now suddenly it's not a one-size product. It's a series of different things coming together, and not necessarily the silver bullet of one product, but several combined in order to make a really effective, tax-efficient drawdown strategy.
I would agree with much of what Amy said. And right now, when I look at lifetime income, when I look at the drawdown, decumulation, whatever you want to call it, to me it's just a natural progression of where we've come with the 401k savings program. These plans started out in the 80s, and the thing that we were focused on originally was participation. How do we get people to start saving? Then we turned, as people started getting larger account balances, we started looking at asset allocation. We started to look at how can we help participants make better, wiser decisions when it comes to investing their assets. Now we're at a point where people have participated in these plans for 30, 40 years, and they've accumulated significant account balances. And so naturally, our new focus should be on how do we help make sure that this retirement savings lasts a lifetime. When we talk to congressional offices, when we talk to staff members, it seems like the two topics they're most concerned about, one is coverage. Everybody always wants to talk about coverage. But the second one that's getting more and more interest right now is this whole idea around accumulation. I think the provisions that are in both RESA and SECURE are important. And I would agree with Amy that right now it seems like it's the plan sponsors who are more interested in exploring lifetime income options. And both the portability and the annuity selection safe harbor, I think, are important first steps to alleviating some of the fiduciary concerns that plan sponsors might have. I do think that Congress needs to continue to look at ways to move forward. And I think the next thing that needs to be done is how can we encourage plan participants to make that decision? I mean, I'm going back years now, but Earl Pomeroy had introduced legislation years and years ago that would have provided tax incentives that would have excluded a portion of distributions that were taken in the form of a lifetime income stream from taxation. And, recently we've heard some members and some staff express some interest. It's an expensive provision, but it's something that's worth looking at. I think what we're seeing right now is an important first step, but by no means is it the end. There needs to be some continued work.
Great. So I've got one last question for the panel and then open it up for questions from the audience. Bigger picture, longer term, outside of RISA and the Secure Act, what are some of the other issues that you think might percolate over the next couple of years, obviously recognizing that the political environment will change, what provisions get the most attention? We heard a lot yesterday in the board meeting from some of the employer groups about the importance of missing participants and auto portability. We've talked about financial wellness, lifetime income, even universal basic income and the potential impact that could have. So I'm just curious your take on, where you think the future might be headed.
Well, there's a number of, legislative initiatives that are in various forms. We talked a little bit earlier about the Automatic Retirement Plan Act, Chairman Neal's bill, which frankly I think is one of the boldest proposals out there, and at Empower we have supported Mr. Neal's efforts, or Chairman Neal's efforts, as I know many have. And the one thing that I've found particularly interesting about Chairman Neal is if you go back to the hearing that was held at Ways and Means in early February, he made a number of references to the importance of the private sector retirement system and how important that was for helping individual workers reach retirement security. And I find that very heartening that he's taken that position. Beyond Mr. Chairman Neal's bill, I also think that we're developing a more holistic approach to retirement savings, and that's including much more than just accumulation of a 401k, your 401k account. We have health savings accounts, and looking at what is the most efficient way to save, and it should include looking at both retirement savings and health savings account. You look at what's been done, proposals that have been introduced by Senator Wyden and picked up by Senators Portman and Cardin on student loans, making it easier for individual or employers to help their employees with student loan debt develop retirement savings. So I think these are all important movements, and I think that as this industry continues to move forward and evolve, we're going to see more of an integration among the various life phases of the individual workers. Individual workers don't break their life up into buckets. And I think to the extent that we can help them pull everything together, we'll be doing service. That's great.
Yeah, that's actually exactly how I think about it. I think our next step as an industry is truly focused on holistic financial health. And you hear those buzzwords a lot right now in the industry: health and wellness, the wellness of your retirement plan. But it's not just one piece. It's many pieces of the puzzle. Do you feel confident that you're going to be able to send your kids to college? Do you feel good about your debt-to-income ratio? Do you feel right about how much you're saving? And do you feel on track? A lot of people, they might be saving 3, 5, 15% inside of their 401k. They still don't know what the magic number is. And so the more we can do to help people really feel like that package is complete, it's easy to understand, it's in one place and they can see it, I think the better off folks will be. I was just at a conference last week, and they said the number one stress of anyone, the first thing that they say is money. That's the one thing that people worry about, and the more we can do to help people feel confident that they're saving the right way, the right dollar amount, the better. There are so many ways, whether you save in a pre-tax situation, a post-tax situation, tax deferred. We really want to help people understand how that tax control triangle could help them move in the right direction. And then at some point, how taking dollars out of those accounts is also going to help.
Great. Jack.
I'm willing to predict 1,000 life paths 65 years in the future. I'm not willing to predict what Congress is going to do, however, next year. I would like to, though, add, because oftentimes this is one of the questions I get after this presentation is, so we're showing how to decrease, 27% of the retirement deficits for the young individuals, given these various legislative proposals. What about the other portion of that? Where's that coming from? And every time we do this, it's the long-term care costs, the catastrophic long-term care costs that dominate this. I did a study with MetLife in 2005 that tried to break this out as far as cost-benefit analysis, and for the second and third income quartiles, there was nothing more powerful from a risk management decision-making process at retirement age in terms of increasing retirement income adequacy than getting long-term care insurance. I know of no proposals out there right now that are necessarily feasible, but if you're looking for ways of attacking those remaining residuals on the retirement deficits, I think treatment of that would be of utmost priority.
Thanks, Jack. So, any questions from the audience? Don't be shy.
Oh, her first. Go ahead.
You can get in
I'm not
line.
the lily white winner.
Good morning, Anna Rappaport. I have 3 questions to ask you about. The first one is that if people claim Social Security at 70, they get about 75% more monthly income than if they claim at 62. And I find it extraordinarily distressing, not only that many people claim early, but how many of those people claimed early without checking out and evaluating the situation. I'm interested in comments both about getting people to do a better job of evaluating, but also whether you think the whole retirement age issue might be addressed, particularly since as we're living longer, the issues of longer work are becoming more important to people, but policy has not supported longer work. Lots of people are trying to do it. So I'm interested if you see any focus on that. I think it's so important, and it's just a can where we're not even visibly kicking it down the road. We're putting it in a closet. And my other issue, Jack mentioned long-term care, but disability before retirement is a huge issue. I grew up in the era when retirement plans had disability embedded in them. As we shifted to D.C., we just threw that out the window and forgot about it. I'm wondering about that as well. I think those are 3 issues that are also critical to our longer-term thinking.
Sure. I'm happy to tackle just the longer work issue, and this is something, not necessarily from a public policy proposal, but that I've seen, but I think we've discussed it internally, which gets back to the gig workers, right, and worker classification. And I think one of the things that employers face, oftentimes they want to be able to have the skills of older workers there, but there is a cost to older workers, and there's a culture in certain cases of needing workers to move on, and if there's a potential to revisit what it might be, and a partial retirement, right, of sorts. As you point out too, people are living longer. They don't necessarily, the traditional retirement and working into retirement and finding other work is a core piece of happiness for many people. And so I think, I totally agree with you. I think that needs to be addressed, and I think that one way you could do that would be looking holistically at worker classification in the future and where that lands. I'll defer to others on the other topics.
Well, thank you very much for the question. I actually thought about the required minimum distribution date changing yesterday when I was listening to you talk about your history, Anna. So I'm glad that we get to address it here. I absolutely agree that we have too many people taking their Social Security too soon. And as a rule of thumb, behavioral finance says that when you tell people they can take it, they do, no matter how much education as an industry we go out and give. And then on the flip side, when you tell people you are, the required minimum distribution, you have to take it, people fight you on it. They don't want that required minimum distribution at 70.5. So it's a really interesting thing that we think about. The first one is we do everything in our power when it comes to financial planning to make sure people understand the trade-off of starting to take their Social Security early or at the age of 62. One of the things that I looked up for this meeting was in 1962, when the first required minimum distribution was set up, it was set up at 70.5 years of age. And to your point, life expectancy has changed since 1962. At that time, 70.5 was the RMD. Your life expectancy was just a hair under 70.5. 70.1 was the life expectancy in 1962. Now, today, life expectancy, if you live till you're 65, for a man is 84, for a woman is 87. This is a huge difference. So the idea that we are talking about moving the required beginning date to 72, I think is helpful. I think it makes a lot of sense. I'm really, really supportive of it. I like the idea of people having those assets longer and being able to live longer with that, those dollars available to them. But we continue to need to really help support people in understanding what the trade-off is when you take Social Security early.
Okay, thank you. Did you? No, go ahead. No, you go ahead.
I was just going to echo, and as far as the RMD increase, I think that's a good thing. Once again, Senators Portman and Cardin would take it even further. The one thing I would note is that increasing the RMD was probably the most expensive element of the Secure Act. I think it came in at about $9 billion over the 10-year period. But I do still also think that this is an issue that needs to be addressed.
Sorry to interrupt you. So a comment and then a question. The comment is maybe it's rational for people to take Social Security early given the system cliff. The question is actually following from the Lillywhite Award winner, and that is back on the question of managing sort of heterogeneity in retirement dates. From the point of view of a plan sponsor, so what I heard was several comments that were very helpful and interesting about national policy, so RMD dates and Social Security dates, and I heard from the point of view of the individual, right? What about from the point of view of the plan sponsor in managing a workforce? And what I'm thinking about is there's been some very preliminary work. There's a paper by Bob Clark and some colleagues on surveying plan sponsors, and much more interest in trying to manage the workforce to figure out who they should keep, who they should get rid of, how they should manage the fact that the older folks tend to get paid more but want to keep them around. And I don't know that we haven't done a lot of modeling of that, for one thing. Essentially that's from the plan sponsor point of view. And I don't know that we've done a lot of thinking about it. I just wondered what you guys might have to say from the plan sponsor's point of view. Thank you.
I can talk about it a little bit. I think that when it comes to people being in and out of the workforce, we are dealing with an entirely new population. People want to take longer breaks. They want to take breaks during their tenure. They'd like to work more part-time. And I think the idea of benefits that are more portable have a tremendous amount of support because of those workers. We haven't done any modeling. What we see anecdotally, though, is the more flexibility that you give individuals, the more likely they are to remain in the workforce. People want to be able to take a 3-month break. They want to be able to spend a year writing a book, and giving individuals that flexibility, or even letting them go to a contractor status, we've seen a lot of success with that.
Yeah, I do think flexibility is one of the keys here, and I'm not aware of any modeling on this as well. But I think there's a recognition that managing retirement date, managing time in the workplace is going to be really dependent upon the type of industry, the type of workplace you're talking about. I mean, if we're talking about a very physically intensive manufacturing job, then that's going to be very different than an office-based job. So I think the key here is giving different types of employers flexibility with their workforce.
We've got time for one last question.
Yeah, I'd like to talk about lifetime income. It's been discussed and debated for years, and we all appreciate the importance of dealing with longevity risk. On the other hand, the population doesn't seem to have much of an appetite for annuities, and for lots of reasons. In part, maybe they don't appreciate the dollar balance they have is not going to go as far as they think. But it strikes me as also a big cultural issue. We just don't trust institutions. The Democrats tell us not to trust financial institutions. Republicans tell us not to trust government. And you need to trust both if you're going to convert your account balance into an annuity. Any thoughts about how to deal with those issues, and what do you think going forward we're actually going to address it and get people to embrace that approach?
Wow, there's a lot there.
I'm the moderator, so I can decline this question.
Well, once again, I think it comes down to education. I think that the reason some participants or individuals haven't embraced annuities, particularly within plans, is really some of the inherent complexities in annuities and not really understanding the need to be able to spread their retirement savings out over a lifetime. That's why I mentioned earlier that I think encouraging plans to offer annuities is an important first step, and making plan sponsors feel more comfortable with having annuities as part of their fund lineup is a very important first step. But it's just a first step. There needs to be continued education at the participant level, and then I also think that somewhere or another there needs to be some way to encourage participants to at least consider annuities as part of their solution. And then additionally, I think Amy mentioned this earlier, when talking about advice also needs to make sure that participants get the support and the need and the information they need to do their long-term planning as well.
I want to thank the panel and thank everybody, and hand it back over to Mike.
All right, that was great. So thanks, Andy. Thanks, Jack. Thanks, Bob. Thanks, Amy. Okay, a quick spin. No break yet until after the next one. Now we're going to shift the gears from retirement over to healthcare. I'd like to invite my panelists to come up. We've got John Young, SVP of Consumerism and Engagement at HSA Bank, moderating. We've got Paul